A short announcement before we head in this week. For those of you who have been past subscribers to markmeldrum.com, you should have received an email extending the all-in purchase price for the applied level to September 30th. My oversight, as explained in the email, is assuming that most of you followed me on YouTube and were aware of the deadline, and then after the deadline got a few complaints about how come we didn't know. So it's extended to you till September 30th. Coming up on week 2 for financial modeling, and we will end week 2 with what you see on the screen. All of our historical data will be entered in. So we'll set up our assumptions schedule, and then we'll have our income statement, cash flow, and balance sheet all entered in terms of historical data. So if we expand each section, you can see what you should end up having when it's all over. And that will be this week. Also, Air Canada did not cancel any flights. So as of Thursday, I will be flying back to Costa Rica. So for the next 3 weeks, I will be producing the content from there before I return back here for a little while. Okay, let's head into what I think is going to be a super exciting week. Let's start with the economic calendar again. And this week, I'm expanding it to a few other countries because I don't know that it's really worth, focusing on one country for recession watch. Maybe it's worth expanding it out globally and having a look at other countries. Let's begin with Mexico. Good data on Monday, and if you followed the peso into Friday, I did say if it finishes below 1965, it could keep running, and it certainly did. Consumer confidence, 47.6. The previous 47.1, that was a revision from 46.9 up to 47.1. It's now 47.6. Takes me a while to get used to this new calendar. Whenever I see green, I think that is a revision to the prior month. But with this new calendar I'm using, it is the R in there that is the revision. And if you hover over it, it tells you what the last reading is. So they're all green. And as I was looking at it, going, they all can't be revised. I must be missing something on this calendar. And it's that little freaking R. Inflation rate, 0.01%. I mean, okay, 2 decimal places, but it seems like a waste of ink to print 0.01. Previous, 1.05. The inflation rate year over year, 4.99, down from 5.57. Core inflation, 0.22, down from 0.32. And year over year, 4%, down from 4.05. Still in the right direction. Core inflation coming down, consumer confidence going up. This could set the central bank up for another rate cut, which could affect the peso strength. But right now we have peso strength mostly on DX weakness. We'll have a look at what weakness in the dollar index has done to certain commodities. I found this one interesting. Total vehicle sales for August, 15.1 million, previous reading 15.8, expectation 15.4, really came down. We can see it here at 15.13 for August. Now that just may be a seasonal effect because you do have usually strong spring, mediocre summer with maybe a month in there that does okay, and then a strong end of year. Here's last year, September through December. If I go back to last August, 15.296. Last July was 15.939. So there is a seasonal effect of it. If you take the monthly sales and you annualize it, there is a bit of a drop there. So I'm not too concerned about it yet. But if we don't see a strong September, last year September was 15.77. If we want to see growth in the auto industry, would like to see it come in better than that, especially now that the yield curve has flattened at the longer end, especially the 5-year rates on auto loans are tied to the 5-year. We should see some growth. Not seeing growth, that would be a little bit concerning. Look at January here, dropped under 15 million, 14.87 all of last year. Didn't get that low. From 2015 to 2020, the monthly sales annualized averaged in around 17 million. Haven't reclaimed that level since. Since post-pandemic, we've been drifting in between 15 to 16 million on an annualized run rate. Consumer credit for the U.S., big jump up, 25.45 billion. Last month was 5.23, revised down from 8.93. So, okay, that might be an overstatement. But look at that increase, and this is the last 12 months here. So it is the highest over the last year, the increase in consumer credit. China, how is China doing? Not too well. Balance of trade up 91 billion versus last month. This is for August versus July at 84.6 billion. Exports doing well, up 8.7%. Last month was 7%. Consensus was 6.5%. But look at imports, up 0.5%. Last month was 7.2. The consensus was 2.5, working off those big inventories. Big inventories of copper, big inventories of iron ore. So it just doesn't need that much coming in. Another product it doesn't need as much of, just because of the sheer increase in the amount of EVs hitting the road, is crude oil, which is having an effect on Brent. We'll see that a little later. On Tuesday, for August, out of China, vehicle sales down 5%. This is year over year, so that's down 5% from the previous August. July was down 5.2% from the previous year. Wow, this is down year over year. U.S. is running between 15 and 16 million on an annualized run rate. China runs between 24 and 25 million. It is the largest car market in the world. But down 5%. Wednesday, the UK. This is all historical here. We're way back in July all the way through. GDP month over month for July came in 0. The month before also came in 0. The consensus was for an increase of 0.2. The trade balance negative, more negative than the previous month. Industrial production negative. Manufacturing production -1. Construction output -1.6. Industrial production year over year -1.2. Manufacturing production year over year -1.3. See a trend going on there. Heading to the U.S. Wednesday morning, 8:30. Inflation. This had an effect on TLT, which I sat back and scratched my head, and I thought, what about this makes you think the Fed's suddenly going to go 50 basis points? If anything, this should have cemented 25 basis points of the market just through a duration party. Yay, front-end loading on these rates. Core inflation came in 0.3. This is month over month for August. This is core, came in at 0.3. Last month was 0.2. The consensus was 0.2. It came in hotter. Inflation rate year over year, unchanged. Inflation, this is core, mind you. Now headline, inflation rate month over month, unchanged, and came in as expected. And the inflation rate headline year over year, 2.5. I think that's where the party was thrown. And we just said, we don't like this number. Let's not pay attention to this number. Let's just pay attention to the number we like. 2.9 down to 2.5. I mean, that's still pretty good. So on a, if we look at costs that we pay on a portfolio basis, meaning headline, we pay for energy, we pay for food. If those things are coming down, well, then we have more money for other things that are up. So, okay, I guess we can throw a party for that. Expectation was 2.6. Some of the sub-indices might have been reason for excitement as well. Let's look at Supercore. This is a month over month, 0.1. And if we look at year over year, 1.6. By the way, if you're looking at the year over year, you'll notice that this is not seasonally adjusted. It does not have to be if it's year over year. Month over month, these numbers are seasonally adjusted. So if you're wondering, where are the seasonally adjusted year over year? Well, because it includes all 12 months, there is no seasonal adjustment that needs to be made anymore. 1.6 on Supercore, 0.1. That is pretty good. All items less food, 0.2. All items less shelter, flat month over month. All items less food and shelter, flat month over month. All items list food, shelter, energy, used cars, and trucks, 0.1. Not until you get into services do you start to see things increase month over month, and same with year over year. Services year over year, 4.8%. Being that services is the bigger part of the economy, I thought that number would get a little bit more attention, but the 2.5 seems to be the thing that was looked at. And again, if you consider that as we add securities to a portfolio, we diversify and we lower idiosyncratic risk. As we add goods and services to a portfolio, a basket of goods and services that we buy, it lowers the overall price level of that basket. So maybe that is the thing to look at. But I seem to think that this over here takes 50 basis points off the table. I don't see 50, but the market insists that it's going to be 50. Let's turn our eyes towards oil now. On Wednesday, for the week ending September 6th, crude oil U.S. inventories up 833,000 barrels. The previous was a drawdown of 6.8 million. Consensus was a build of 1 million, so it was lower or less of a build, but gasoline, big build, 2.3 million gallons. The previous week was a build of 848,000, and there was a consensus that there'd be a drawdown of 100,000 barrels, wrong way. Also, you didn't have to listen very hard or look very far last week to find all sorts of discussion about the price of oil and the bearish tone that is out there. Here is a 2-year chart of WTI. Here's a $70 price target, and we did break down under $70. However, we attempted to recover the $70 mark by the end of the day on Friday. This is a 1-week chart. It dipped down into the $68 range and attempted to come up at the end of the day, but didn't make 70. We got down to, where is it here, $65 on this one. There have been a couple of times that it has broken down under 70. And this is Oxy. We can see Oxy's held fairly constant at around 57.50. Seemed to be well supported around 57, but that has broken down considerably. Oxy printed under 50 for a few days last week, ended at 51.14. I got quite a few emails and messages. What's going on with Oxy? And this seemed to be a natural thing to happen to Oxy as the price of its output is decreasing. The price of its stock will decrease as well. It tends to decrease faster because you have both operating leverage and financial leverage within Oxy. But we did have a nice recovery. Oxy just didn't want to play along with it. And this recovery really is tied to the dollar. The dollar really, around early Thursday morning, the dollar started dropping significantly. And commodities usually get a boost when the dollar drops. Gold, for example. And gold is being driven by other things, but a falling dollar certainly helps. Copper really helped that out. And it did help out WTI to some degree, but it did not help out Oxy. So what I'm going to do for Friday is we'll take a deeper look at Oxy, its current conditions, and I'll put that in positions for September 20th. We'll do a couple of screens with a little bit of a deeper dive on Oxy to see if we can't figure out what could be the cause of its material weakness, even while oil recovered, and if we can sort of come up with some idea of where we think it might be headed from there. If the worst is over, if there's more to come, but we'll do that on Friday, Friday, September 20th. We'll stick with the oil sucks theme for one more screen here. A couple of screenshots I found that are interesting. Money managers turned bearish on Brent. Milestone hit for the first time in records back to 2011. This is net bearish. Here is the line. It is the first time since 2011 that you have a net bearish position for money managers on Brent. If you combine both Brent and WTI together, combine net longs, you're still net long positive, 139,000 contracts. but it is a record low for the net bullish position. So for this top one here is just ICE futures data for Brent, which could be a function of just Europe and China. However, NYMEX on its own is still net bullish on WTI. This is rig count by major basins. So you can see the rig count has been decreasing, and that is a big function of enhanced oil recovery. If you're not familiar with that, or the effect that it has in the applied level, in understanding O&E producers in the energy sector, I explain enhanced oil recovery, probably with a little more geological detail than you would want, but I do explain it. Oxy is in the Permian. Here is the Permian in orange here, and this is the rig count. It's been held, seems like, fairly constant for quite some time. So even though the rig count seems to be coming down, if we look at the size of the orange in here, it looks like it's been fairly constant throughout 2024. The IEA, the statement from IEA now expects China to see an increase in demand of 180,000 barrels per day in 2024. That 180 is down significantly. It really should say now expects to only see an increase in demand of 180,000 barrels. The growth engine, China, has thus become a drag on growth for the next year. The IEA expects only a slight acceleration. Global oil demand is expected to increase by 950,000 barrels per day, with demand in China rising by 260,000 barrels per day. This means that global demand growth would lag behind the IEA's expected increase in non-OPEC oil supply. Said simply, supply will outstrip demand. Consequently, the call on OPEC will fall to an average of 26.2 million barrels per day next year. That is a good 1 million barrels per day less than OPEC's current production. OPEC would therefore actually have to reduce supply next year to avoid a surplus. The gradual increase in production that has been planned so far would result in a considerable oversupply. So we'd be relying on OPEC to balance the market. Is OPEC going to say, okay, we'll cut back while the non-OPEC suppliers continue to increase their supply, we'll keep cutting back? Or will they say, whoa, market share here? Most of them are lower cost producers. So if they create a supply glut, it would put downward pressure on the price, but it would shut down a lot of the wells from non-OPEC producers because they are high cost producers, but you'd have to drive that price down probably under 60 to start shutting down some of those wells, and maybe even under 50 to really add some discipline to what is going on in the U.S., because output in the U.S. is at record highs. However, that can come off very quickly if you get the price of oil to break 60 and then to break 50. You keep it there for a prolonged period, you're going to make a lot of oil producers a little gun shy about reopening wells and introducing more CapEx. But it does not look good, because at this point, non-OPEC producers have nothing to discipline them. If OPEC says, okay, we'll cut some more, well then they'll continue to do what they're doing. I don't see this ending well for the price of oil. I don't think OPEC is just going to sit back and say, yeah, we're comfortable cutting back while you guys increase. Let's look at the futures curve for both WTI, which is the top chart, and Brent, which is the bottom chart. The shape of this curve is called backwardation. This happens when the spot price is above the front month futures price. So here is the front month futures price. So the spot price is somewhat higher, and it's dragging up the front end of the curve because it is higher. Same here, the spot price is higher. If you have a condition of oversupply, the spot market price drops and it drags the curve into contango because it starts pulling the front end of the curve down below the flatter part of the curve. So if you do get a condition of oversupply, the spot price will drop below the front month and the curve shifts into contango with the front of the curve dropping. Contango is a shape of a curve where you have an extremely oversupplied spot market. Well, what do we see right now? The spread between, I just take the long end of the curve here and where the front month is, you got $5.50. So to drag this curve into Contango, spots would have to drop by at least $5.50, but not so much with Brent. $3 really, $2.90. It is closer to becoming a flat curve and then a Contango curve than Brent is, than WTI. Once in Contango, trading strategies shift, which then puts more downward pressure on prices, and it affects sentiment at the same time. However, with dropping energy prices, that is actually bullish for consumer spending because they're paying less at the pump. There's less of transportation costs built into shipping products or shipping I shouldn't say shipping services, but the shipping services companies would then have a lower surcharge per mile driven. So it could be bullish for the consumer, but certainly not good for the oil complex and companies involved here because their costs stay the same, but every dollar down on oil is $1 less in revenue per barrel of output. Thursday, we got PPI. And again, TLT, not until the end of the day, TLT seemed like it wanted to throw another party. Yay, 50 basis points. I don't know what in here suggests 50 basis points. PPI month over month came in up 0.2. Previous was 0. The consensus was 0.1. Came in higher than consensus. The core PPI 0.3. The previous month was negative 0.2. And the consensus was 0.2. Came in higher than expectations. PPI or core PPI year over year 2.4 up from 2.3 reading the month before, lower than the consensus but still up. And year over year 1.7. I think if you're going to throw a party, that's probably what you're looking at, but a lot of that is coming out of energy, which we've already seen has been dropping quite a bit. And when energy drops, food prices drop. Why is that? Anybody? Bueller? Is because food is grown over here, but it always has to be shipped to different places as well. Also, it requires energy to grow food, tractors, all that sort of thing. So if you lower the cost of energy, you actually lower the cost of food being distributed to certain destinations. So the lower the price, and that's, under normal conditions, the lower the price of energy, the lower the price of delivered food to the shelves in the supermarket. 1.7, maybe that was where the party was. PPI ex food, energy, and trade, that means taking out margins, came in as expected, unchanged. And year over year, taking out food, energy, and margins, 3.3, up from 3.2. And a couple of times last week I heard analysts on, whether it be a podcast or on Bloomberg, talk about PPI, saying PPI is a leading indicator because it's prices that producers pay. No, it is not. No, this what's being reported here is final demand. This is PPI for final demand. I know I've explained this several times, but it is worth emphasizing again. PPI has two types of indexes, final demand and intermediate goods. Intermediate goods can be a leading indicator. That can be a leading indicator. However, final demand is just the opposite side of CPI. You have two people over here. One is a consumer, one is a producer, which means it is selling something to the consumer. You have a CPI person watching what the consumer pays. You have a PPI person watching what the producer receives. They are just on different sides of the same transaction. This guy over here says, how much are you paying for this? That includes tax. So if there's an increase in sales tax, there's an increase in inflation. Over here, this PPI person is saying, what did you receive? That is without tax because the producer doesn't get the tax. That goes to the government. And this person over here does not care who is paying for something. So it could be the consumer or it could be a health insurer. that is paying for something. If it's a health insurer paying for something, it's not counted in CPI, only what the consumer pays. So what is counted in CPI is health insurance. Over here, the producer is agnostic to who pays them for something. It is just the other side of the transaction when we're talking about final demand. So it is not a leading indicator. It is the other side. Take a coin. One side is CPI. Flip it over. The other side is PPI. Just opposite sides of the same coin. Initial jobless claims 230,000. That's still low. The week before was 228. Came in as expected. And continuing jobless claims 1,850,000. Up from 1,845,000, but came in as expected. Export prices. This is something interesting, right? We have month over month and we have year over year. Export prices month over month, negative 0.7. Import prices, negative 0.3. From what were positive reads the week before. Export prices year over year, negative 0.7. And for import prices, 0.8. Well below 2% level. Friday we got consumer sentiment. Came in at 69. Just to put things in perspective, what I've done here is I put the current economic conditions and expectations. So consumer sentiment is a weighting of the two indexes. The what do you think about where we are now, and what do you think about where we're going to be? And it just weights them to come up with sentiment. 69. Expectations and current conditions. Current conditions 62.9, up from 61.3, but look where it is. I mean, it's still quite down there. And if we look at expectations, 73 versus 72.1, expectations have been coming up. The expectations about the future, because it deals with hope, usually always come in higher than the current expectations. So unless you have current expectations that are degrading quickly, expectations don't really change much. Here you see this big drop in current conditions, and it was followed by some drop in expectations, but then, not much more of a drop, but hope. So this is more of a hope index, and this is more of a reality index, right? Because this is the current conditions that we're in. This is what we hope will happen. I discount expectations. I think current economic conditions are all you really need to look at. But that came in higher than the month before. Things are getting better. How much of that is a change in the political narrative? Harris-Walz seems to be gaining more momentum. The debate did not serve Trump well. So some of that could have been a result of that. That is for September. I don't know if it captured the debate or not. I'm just throwing out ideas. Baker Hughes rig count is worth watching because if oil does shift into contango, which sort of is the watch I think that we would be on, is that futures curve. That shifts into contango. We are bearish. 485 up from 483. And total rig count, this is oil rig counts. Total rig counts is oil and gas, 590 up from 582. There's the one right there, 485 up from 483. Two more rigs pumping oil. So there is a day of reckoning coming for the oil market. I think we can all see that, unless China gets a significant resurgence of consumer demand. But with so many EVs hitting the roads in China, I think, the writing is on the wall that I think China, we can probably say, has seen peak oil demand and probably will decline in the decade to come. And I think most countries in the world probably are at or near peak oil demand. So it's going to be interesting to see how this plays out, but it's in everybody's best interest to keep that price over $70. Because if everybody, you get tragedy of the commons, right? If everybody starts producing as much as they can to maximize their revenue, no one will maximize any revenue. You can call that a prisoner's dilemma as well. Curve steepening continues. 9 basis points. It's still inverted on the money market to capital market curve. Canada still inverted on the capital market curve. Look at the change in yields again, all lower. You start looking at the 3-month, 4.97, under 5%. What this is saying, it's a constant maturity that if you issued a T-bill today, a 3-month T-bill today, maturing in 3 months, September, October, November, sitting at 4.97, effective federal funds rate 5.33, range is 5.25 to 5.5, sitting at 5.5 for the longest time. Now 4.97. You can't get there without a 50 basis point cut somewhere along the way. I think that's wrong. Look at the 4-month, 4.92. Going out to the 1 year, 4% from 5.25 to 5.5 using the federal funds rate of, and that really works better with Fed funds futures, but 133 basis points lower, pricing in almost 10 rate cuts over the next year, 10 25 basis point rate cuts. I think that's wrong. And of course, the 2-year 3.57. It's hard to say whether that's right or wrong because, you know, if you spread them out over 2 years, maybe, but certainly not in the next year. This is not an economy that is in that needs emergency support like 50 basis point cuts. And even though we've had some Fed speak and some misinterpretation of some Fed speak saying, oh, Waller wants to front-end load. No, he does not. He said he would be open to it if you had a significant deterioration in the labor market, not a softening in the labor market. Even 80 to 100,000 jobs a month is perfectly consistent with a normal market. They're not going 50, which sets up a big reckoning on Wednesday, I believe. Balance sheet, not much to see here. 7.1 trillion versus 7.1 trillion. The SOMA increased by 75 million, and that is probably just the tips. Capital portion increasing. So no real change on the SOMA. Almost no change on the balance sheet. As far as curvature still continues to come out as you get a steepening curve. As this number gets bigger, this number will move towards zero. I have a worried looking fellow down here because for money market funds increased by another 23.37 billion. The market is throwing one hell of a party. Duration is throwing one hell of a party, but money just keeps flowing into a security or into securities that are decreasing in yield very quickly. Retail up another 6.2 billion, institution up another 17 billion. Both up on government securities, retail adding to prime, decrease in prime on institutions. This is at odds with a market that just seems to be saying, here we go, buckle in, we're about to accelerate on the market. We've been this low for how long? This low. We're hitting all-time highs, and we haven't even cut rates once. The market is pricing in way too many rate cuts, throwing a party everywhere, but money market funds keep going up. One of those two things are wrong. Okay, 3 days from the final showdown. 55% on 25, 45 probability on 50, up from 30. Market is really pushing to this, and not one bit of data last week suggested, over the week before suggested, that it's 50. Canadian CPI in 2 days. You're going to get more rate cuts. I don't know that this really affects the pace of rate cuts. Not Polos, that's the other one. Meldrum has already signaled as much. U.S. retail sales in 2 days. Bank of England rate decision in 4 days. Japan, busy. Thursday night, CPI. And then at midnight, at least on the calendar it says midnight, you get a rate decision from Japan. That's going to be a big risk movement there. You get the FOMC on Wednesday. You get the Bank of England on Thursday. Thursday night, you get Japan. If they raise rates or signal that they're going to raise rates, watch the yen. And the yen could then cause some problems somewhere because, well, we don't know what's on the other side of that carry trade. We don't know. And then Friday, Harker will speak. Let's go to December. Pretty much unchanged here. More than 3 cuts was 91%. We're sitting at 90%, down 1%. Very little movement here, but nothing deterred the heavy rate cutting camp from moving. It's like, no, we insist that by the end of the year there'll be more than 3 rate cuts. More than 3 because, what are we talking about? Only 3 rate cuts. The market's saying, I give that a 10% probability, 90% that there will be more. Look at the weight on the 425. Look at that, 40%, right? On 5 by the end of the year, 40%. Oh, man. Something has to fall apart very quickly for that to happen. Reverse repo, September 6th, under 300 billion, 299, now 284, down 14 billion. The lowest happened on September 11th at 279. So now we are on our way towards zero again. TGA 725, not much to see here, down 45 billion. Reserves 3.3 trillion, up 95 billion, which puts it at a runoff of 40 billion a month, puts it at 28.6 months for runoff. I don't think it'll be 28.6 months because as they do drop the rate, when we look at MBS, prepayments will begin to increase on MBS, and this 40 will begin to increase, which will drag this monthly rate or this monthly term to the end of runoff downwards. Real rates all took a big drop down. Look at that 5-year down to 1.48, and inflation expectations moved upwards still. The 5 to 7, even out to the 10, hanging right around the 2% mark. Fed funds futures. This is calculating or at least implying what the effective federal funds rate would be by the end of the month. Q3 is pricing in 36 basis points lower on the Fed funds rate, 36 basis points of cuts. Q4 another 81, so 117 basis points by the end of the year. Call that 5 rate cuts. We get the SEP in 3 days. I think it'll show 3 rate cuts, not 4 to 5. Q1, let's throw another 70 on. Q2, market wants another 43, so another 114, 231 just in the next, I should say the next 12 months, not the next 12 quarters. NTM, next 12 months, 231. I believe that is complete fantasy, given who this Fed is and everything I've heard. I think it's complete fantasy. I think a long position in the July 25 ZQ makes a lot of sense because how much more are you going to get? You think that they're going to come out and say 231 basis points? We were thinking more along 300 to 350. That's not going to happen. It is going to be far shallower than 231 basis points. So we'll get a terminal rate for the end of 2024, and we'll get a terminal rate for the end of 2025 in the SEP. And I think you get one as far out as 2026, a terminal rate, and it will show a far shallower pace of rate cuts than the market is pricing in. So I think a good Fed play would be long the July 25 ZQs. And they begin trading on Globex Sunday night at 6 p.m. So you don't have to wait until the next day to do it. So I haven't put this on. I'm looking at that thinking, you know what? As a flyer on the Fed meeting, yeah, I think I would. Not many, maybe 10 or 15 contracts. I'm not going to really load up. But what's my downside? Does anyone really think the Fed is going to come out and be more dovish than 231 basis points of cuts in the next 12 months? Show of hands, right? That's just not going to happen. Well, I shouldn't say it's just not going to happen. I place as high a probability on it not happening as the market is placing a probability on 4 or more rate cuts, 90%. TLT up 0.85. I don't know why, but there it is. SPX up 4%. Implied volatility pretty much disappearing on TLT. Last week, 73% on 13-week, down to 16. IV just dropping away. I have made changes to TLT, significant changes. You can find that in the positions folder in portfolio construction module in the applied level. 30-year fixed rate mortgage, look at that, down to 6.2, 20 more basis points. We get a 5 handle on there, right? Down 15 basis points for the week. The 10-year Treasury was down 5, so spread decreased by 10, down to 252 basis points, which helped both agency and annually. Look at ABR, what a week ABR had, up 8%. All the home builders, this here is more of a casino stock. Let's just call it what it is, right? All the home builders, and Lennar has earnings this week. They have earnings this week, so if you're in Lennar, careful. It's also a Berkshire holding as well. They have a small position in Lennar. And of course, if they're up, so are the 2 ETFs that track home builders and home construction. XLU still continuing to perform, and IYR. The REITs have been on fire the last 2 weeks. Who's in REITs? Who has had a good time in REITs? As you know, I was heavy in Canadian apartment REITs. I've gotten out of my 2 smaller positions. I still have a position in the larger one, but I'm certainly selling into the strength. I don't know how much further they can go. I think you have a lot of Fed risk built into REITs. REITs, again, if you've been anywhere near REITs, they have been on fire. 10, 15, 20% up in the last couple of weeks. Just on fire. Same with utilities. Unstoppable on the utilities. And I have had long positions on both. If you've been following this weekly video series for a while, you know that I've been promoting certain REITs and utilities for quite some time. It has been one hell of a beautiful year. Plus, you know that I was really heavy on duration, and that has performed extremely well, but a little too well. So if you have the applied level in positions last week, I did talk about what I'm doing there. Nothing to see over here. I still find this on high yield, spread widening on triple B and double B, but the lowest part of high yield, no, give us some of this, but we don't want any of we don't want the high yield stuff. We want the really high yield stuff. You gotta say, right? Usually you do that. You migrate down in credit quality if you think that the economy is going to be really, really good going forward, because spreads would tighten, which doesn't make sense on these over here. So again, slight anomaly going on here, but you got a lot of illiquidity in corporate bonds, so it could just be a valuation issue. I'm not going to read anything into it because these things, that's barely moving, right? Mortgage apps for the week up 1.4%. What do we got coming up this week in the housing market besides Lennar earnings? Tuesday, National Association of Home Builders Housing Market Index for September. The previous reading was 39. It's a diffusion index, right? Anything under 50 is contraction. Previous was 39. Expected to be 40, further contraction. Wednesday, building permits for August and housing starts for August. Thursday, existing home sales for August. Cannot get through this week without talking about gold. The futures contract, GC, all-time high on the front month futures contract, which is December 2606. It's important to say that is not the spot market price. That is the futures price for December. All-time high, which puts the spot at an all-time high. So if you had this little line here of resistance well above that, because, 50 basis points and a shift into believing that Harris is probably the next president and her policies will be hugely negative for the debt, but so would Trump's. But Trump would come with some growth because it would extend the tax cuts. Harris will not. So success will be taxed and wealth will be redistributed, which is not those kind of redistribution policies are not supportive of growth. So you will have higher debt and higher taxation without the corresponding economic growth to back it up. So gold is like where everyone is going. There we go. Part of this increase here was the dollar index. Here's DX. Here's Thursday, early Thursday. It started just crashing downwards. That does support the price of commodities. Dollar was lower. We saw gold higher, and for 2 days, copper just booked in some gains, even though you have high levels of inventory. It is denominated in U.S. dollars, so to keep it constant in other currencies, the price of the U.S. dollar, the U.S. dollar price of copper would go up, so it's constant in other currencies. So if you were in Australia or in China or in Japan or in Europe, the price of copper stayed the same, maybe even decreased. But because it's priced in U.S. dollars, the lower the U.S. dollar goes, the higher the price of copper goes. Oil did come along for a ride at the end of the week, but oil has its own pressures going on right now. So I don't know that I would look for a continued lower dollar index to support the price of oil. It has its own supply and demand dynamics it's going to have to work out. But it's certainly going to support the price of gold. So Newmont and Freeport still continue to be winners. Newmont produces a lot of gold, and its secondary product is copper. Freeport produces a lot of copper, and its secondary product is gold. So higher those prices go, the better it is for both of those suppliers. Producers, not suppliers, producers. Before we get to the S&P 500, scrolling through LinkedIn, I found this chart in one of the posts. S&P 500 valuation metrics. Source here is FactSet, CompuStat. By the way, FactSet has earnings this week. Bloomberg, B of A, U.S. Equity and Quant Strategy. Quite a few inputs here. Valuation metrics, there's a whole bunch of them. What is important is the Z-score as well. Anything above 1.96 is a 95%, falls outside of a 95% confidence interval. Anything over 1.645 falls outside of a 90%, and anything over 1.44 falls over an 85% confidence interval. So let's look at the metrics that fall outside of a 95% confidence interval. By the way, this is basically telling you that by almost any measure, this market is overvalued. On every single measure, it is overvalued. Some of them not significantly. Those are the ones in the red boxes. The Z-scores are too small to be significant. On a trailing PE, 2.1 falls outside of the 95% confidence interval, 24.9 versus an average of 14.9. Next one here is the Schiller PE, 2.4 on the Z-score, 35.1 current, average is 17.5. Kind of makes you a little worried, right? Next one here is the price to book value, 5.09, average is 2.7. However, with the inclusion of more and more tech companies in the S&P, tech companies tend to have a lot more intangibles that are not really on their asset side, so you would get higher price to book. I don't know that I would put too much into that one. This one here at 2, this is enterprise value to EBITDA, 15.5, average is 10.6. We got another 2.2 over here, price to operating cash flow, 1.91, sorry, 19.1, average of 11.4. We have another one here, enterprise value to sales, 3.27 versus an average of 2. S&P 500 in WTI terms, 74.2. 74.2. Let me tell you why that one is important. Usually the same things that drive economic activity drive the demand for oil. Usually the same things. So if we are in a contraction, usually the demand for gasoline, the demand for oil drops, but so does the price of the S&P 500. In an expansion, prices rise, but so does the demand for oil and gasoline, so prices rise. So usually there is some ratio that we would expect because they have the same causal factors, economic growth and economic contraction. Since they have the same causal factors, we would expect a stable ratio. 74.2 versus 27.3. And then the final one here, S&P 500 market cap to GDP 1.66, average 0.67. That is a big difference. Look at that, 147% above 2.8. I think that is the biggest Z-score on here. Let's look at the ones that there's nothing above 90. Nothing. Well, yeah, there's a couple around the 1.6, but they're mostly above the 144. That is your trailing gap PE, 28.7 versus an average of 15.2. Forward consensus PE, 21.6. We'll see that on the next screen. Average 15.9. 1.6 on the Z-score. Trailing normalized PE, 26.5 versus an average of 19.1. Median forward PE, 18.4 versus the average of 15.5. What is that? Take all the companies, take their forward PE and find the middle one. What else do we have in here that looks interesting? Down here, the S&P 500 dividend yield versus 10-year Treasury yield. I don't know if I really care about that too much. And the S&P 500 versus the Russell 2000 forward PE, 1.38 times versus 1.04. Still very low. What doesn't matter in here, trailing peg, forward peg, almost nothing here. I mean, it's in the overvalued side, but not enough. If you think about the normal distribution, right? You have your mean, and because it's statistical, there's going to be some variation. So if you go out to the corners, you leave 2.5% in each tail. There's your 95% confidence interval. If you're 0.4, within one standard deviation is 68% of all observations, right? So by being 0.4 and 0.4, you're well within that 68% range within one standard deviation. You call that fairly valued, really. So based on a trailing peg and forward peg, not much to see here. This one here is price to free cash flow. Not much to be said about that one. This here is 7.9. This is enter the equity risk premium, market-based equity risk premium. 546 right now versus 506 on the average. So 546 got a bit of a higher premium. 7.9 sort of sitting outside. Don't know what to, it's there's nothing to say about that, being that it's so close to its median value. Same with the normalized equity risk premium, 0.7. Who really cares on that? S&P 500 in gold terms, 0.5. S&P has just been hitting all-time highs, but gold has been hitting all-time highs. I can see the story for gold, but for the S&P to keep hitting all-time highs, that one is a curiosity. Anyways, I thought you might find this interesting. All of the different metrics on which you can value the S&P 500, and all of them are showing that the market is overvalued, with some of them above 85% or outside the 85% interval, and some of the bigger ones outside the 95% interval. SPY, look what we got forming in the right part of the chart. Is that a triple top I see? 1, 2, and 560, 175. Market technicians will tell you there are no triple tops, so that the expectation is we're going to break through that. But we've broken pretty much every economic and technical rule there has been in this cycle, so we could easily just go down. Flip a coin, and you will be just as good as these technical indicators. Forward 4-quarter operating earnings, 259.80, down from 260.60 the week before, and I have been hearing on Bloomberg that analyst estimates for earnings have been coming down, so we should start to see that showing up in that number over the next few weeks. SP Global 257.36, still stuck on August 30th. That spreadsheet doesn't look like it's been updated, so I don't know what's going on with Howard, but if you're listening, say something, because I'm giving up on you. Forward multiple 21.65. I'm only using LSEG at this point. 21.65. Previous screen we saw 21.6, so there's verification, up from 20.88. Surprise factor for the previous quarter was 4.6%. So if we expect this to continue on. And it has not. The surprise factor was higher the quarter before, and I extended that out for the year, saying this is what the multiple would be if in fact we got that. We did not. We're at 4.6, but you can put 4.6% higher on that, divide it through with the 56.26 and see what multiple you get. 50-day moving average, just under 550, 2% below where we are. And the 200-day moving average at 515, 8% below where the closing was. Implied volatility drifting away, but not that fast, not as bad as TLT. 59% over the last 13 days. Last 13-week observations were in the 59th percentile. Earnings this week, LSEG says 6, sectorspdr.com says 5. Wednesday, General Mills. Thursday, two big ones here, FedEx and Lennar. We also have Darden Restaurants, and I think that is probably going to have some effect on Lamb Weston, which earnings are October 1st on that one. And FactSet Research, which I'm inherently uninterested in this one, but FedEx will be interesting. Especially their guidance in Lennar will be interesting as well. And that's it for this week. Your big risk event, well, I don't need to tell you what it is. It's 2 o'clock on Wednesday. Everything before that is just the pre-show interviews. That's the big one. There'll be a 25 basis point cut, and I think the market will react negatively, then positively, then negatively, then positively, then negatively, then positively. And then the press conference will start where the market will then react negatively, then positively, then negatively, then positively. You get what I'm saying? I don't think it'll be till 3:30 to 4 till we figure out what the direction is. And even if you get a 25 basis point cut and the market decides to throw a party, those things usually reverse the next day. So we might not even get the real move on the day we get the decision, kind of like U.S. elections, right? It might be weeks before we know the outcome. But you're certainly not going to know that night. I don't expect 50. I don't think, in listening to almost every analyst that Bloomberg interviews, no one thinks it's 50. I think maybe one or two thought it was 50 because you have to have diversity of opinion, right? But everyone's in the 25 basis point camp. But, tap the market on the shoulder and whisper in their ear and say, "Psst, have you heard? No one believes you." I don't see the SEP supporting what the market has. To me, it seems like anything duration-based is going to have a bad week. I think TLT will give back. I think REITs will give back a lot. I think utilities will give back a lot. But in giving back, hopefully they can give back well into Friday. That would set up a buying opportunity for those duration-based assets. But right now, I think duration is more than fully priced at this point. I don't believe the Fed is going to support the valuations for duration-based assets. So govern yourselves accordingly throughout the week, and let's all get our popcorn ready for Wednesday at 2 p.m. That's it.